Let me tell you about a tax that was designed in 1983 to affect only wealthy retirees. A tax that was deliberately aimed at the top 10% of Social Security recipients, people with substantial outside income who Congress decided could afford to pay taxes on a portion of what they collected. That was the intent. Here's what actually happened. Because the income thresholds that trigger this tax were never adjusted for inflation. Not in 1990, not in 2000, not in 2010. Not today. More and more ordinary retirees have been pulled into it every single year. The Congressional Budget Office estimated that roughly half of all Social Security beneficiaries were paying federal income tax on their benefits by 2021. A 2015 Social Security Administration projection estimated that by 2050, more than 56% of Social Security recipient families will owe this tax. The group that was supposed to stay below the threshold, the ordinary middle-income retirees, this tax was never designed to reach, is now the majority of people paying it, and most of them have no idea it is happening or why. But the tax itself, as bad as it is not even the worst part. The worst part is a mathematical effect hiding inside the formula that can push your effective tax rate to 40% on a single IRA withdrawal, even if your stated bracket is only 22%, even if it is 12%. It is called the Social Security Tax Torpedo. And by the end of this video, you are going to understand exactly how it works, exactly who it hits, and, most importantly, the 4 specific moves that diffuse it before it detonates on your retirement income. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making decisions about your specific situation. My name is Kevin, and every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. Let's get into it. To understand why this tax catches so many ordinary retirees, you need to understand where it came from. In 1983, Social Security was in a financial crisis. The trust fund was nearly empty. Congress and the Reagan administration needed to find money fast. Among the solutions they chose was taxing Social Security benefits for the first time in the program's history. But they were politically careful about it. They set the income thresholds high enough that in 1983, only the top 10% of Social Security recipients, people with substantial pension income, investment returns, and other outside income, would be affected. For an ordinary retiree in 1983 living primarily on Social Security, the tax was invisible. It did not apply to them. Then in 1993, the Clinton administration added a second tier, a higher threshold that would subject up to 85% of benefits to taxation for higher income recipients. This tier sent its revenue not to the Social Security Trust Fund, but to the Medicare Hospital Insurance Fund, a policy detail that matters because it means Congress has a direct financial incentive to let these thresholds keep dragging in more payers every year. And here is the mechanism that has quietly turned a tax on the wealthy into a tax on the middle class. When you were working, your wages rose with inflation. When you retired, your Social Security check receives annual cost of living adjustments. Everything in your financial life goes up over time. The thresholds that determine whether your Social Security is taxable have not moved once since they were set in 1983 and 1993. Not once. In 2006, the thresholds are identical to what they were the year they were written. A combined income of $25,000 triggers Social Security taxation for a single filer. The same $25,000 that applied in 1983, when that represented a comfortable middle-class retirement, in today's dollars, adjusted for inflation, that $25,000 is worth roughly $76,000, which means a retiree who in 1983 would have been well below the threshold and paid nothing is now well above it, through no change in their real standard of living, simply because inflation has slowly dragged them over a line that never moved. This is not a bug in the system, it is how the system funds itself. Every year that passes, every COLA increase, every dollar of investment return pushes more retirees over a threshold Congress has no financial incentive to raise. Now, let me show you the actual formula, because most retirees who are paying this tax do not fully understand how the calculation works, and that lack of understanding is exactly why they cannot reduce it. The IRS uses what it calls provisional income, sometimes called combined income, to determine how much of your Social Security benefit is taxable. Here is how you calculate yours. Step 1. Take your adjusted gross income. That is everything on your tax return before deductions. Wages if you're still working, pension income, IRA withdrawals, dividends, capital gains, rental income. Everything except Social Security itself. Step 2. Add any tax-exempt interest you earned. This is the one that surprises people every single time. If you own municipal bonds, bonds specifically purchased because the interest is tax-exempt, that interest still counts toward your provisional income. For this formula, the IRS specifically included it in 1983. Your muni bond interest does not get taxed directly, but it counts toward the threshold that determines whether your Social Security gets taxed. Step 3. Add half of your annual Social Security benefit, not all of it. 50%, add those three numbers together. That is your provisional income. Now compare it to the thresholds. Tier 1, no taxation. If your provisional income is below $25,000 as a single filer, or below $32,000 as a married couple filing jointly, none of your Social Security is taxable. 0. Tier 2, up to 50% taxable, if your provisional income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 married, up to 50% of your Social Security benefit becomes part of your taxable income. Tier 3, up to 85% taxable. If your provisional income exceeds $34,000 as a single filer or $44,000 as a married couple, up to 85% of your Social Security benefit becomes taxable income. Let me put real numbers on this. You are single, 68 years old, you have a pension of $14,000, you take $12,000 from your IRA, you have $1,000 in dividends, you receive $22,000 in Social Security. Provisional income, $14,000 pension, plus $12,000 IRA, plus $1,000 dividends, plus $11,000, half of Social Security, equals $38,000. $38,000 is above the $34,000 upper threshold. Up to 85% of your $22,000 Social Security, up to $18,700, is now added to your taxable income. At your marginal rate of 22%, that is $4,114 in federal income tax on your Social Security check, on $22,000 in Social Security income. Money you paid into for 40 years, your effective tax rate on that benefit is nearly 19%. And if you had not known about the formula, if you had simply looked at your pension and IRA withdrawal and assumed your tax situation was straightforward, you would not have seen it coming. Now, here is the part that makes this genuinely alarming. The formula I just showed you does not simply tax a fixed percentage of your Social Security once you cross a threshold. It creates a zone, a specific income range, where every additional dollar you earn triggers a cascade effect that can nearly double your effective tax rate. Tax professionals call this the Social Security tax torpedo. Here is the precise mechanics. When your provisional income is in the phase-in zone, between the lower threshold and the point where 85% of your benefits is fully captured, every additional dollar of income you bring in does two things simultaneously. First, it gets taxed at your ordinary rate. Second, it pulls an additional 85 cents of your Social Security benefit into the taxable column, which means you are being taxed on $1.85 of income for every $1 you actually received. At a 12% marginal tax rate, the math is this. 12% times $1.85 equals 22.2%. Your effective marginal rate on that withdrawal is 22.2%, even though your stated bracket is 12%. At a 22% marginal tax rate, 22% times $1.85 equals 40.7% on a dollar of IRA income in a bracket where you would normally pay 22 cents. T. Rowe Price confirmed this number in a 2025 analysis. The Bogleheads Wiki documents the exact income ranges where the 40.7% rate applies in 22.6. The Financial Planning Association published peer-reviewed research on this effect going back to 2018. This is not a fringe calculation. It is real, it is documented, and it happens to ordinary middle-income retirees who have no idea why their tax bill is so much higher than their bracket would suggest. Let me make this concrete with a scenario. Meet Robert and Carol. Married, both 70. Their baseline income is $48,000. A modest pension, some dividends. Combined Social Security of $38,000. Their provisional income is $70,000. They are already in the 85% taxation tier. They pay tax on 85% of their Social Security each year. That is understood and accounted for. Now Robert needs a new roof. The estimate is $18,000. He calls his broker and asks for an $18,000 IRA withdrawal. He expects to pay roughly $3,960 in federal income tax on that withdrawal, 22% of $18,000. That is what being in the 22% bracket means to him. What actually happens? The $18,000 withdrawal is already in the 85% torpedo zone. Every dollar pulls 85 cents more of their Social Security into taxable income. The $18,000 IRA withdrawal triggers an additional $15,300 in taxable Social Security. His total additional taxable income is not $18,000. It is $18,000 plus $15,300 to $33,300. At 22%, his tax bill on an $18,000 withdrawal is not $3,960. It is $7,326. He spent $18,000 on a roof and paid $7,326 in taxes to do it. An effective tax rate of 40.7%. He had no idea this was coming. His advisor never modeled it. His tax preparer filed the return correctly and said nothing about it because there was nothing technically wrong. The calculation is what it is. But if Robert had known in advance, he could have split the withdrawal across 2 years. $9,000 this December, $9,000 in January, potentially keeping both years' provisional income lower and reducing the torpedo impact significantly. The knowledge is worth thousands of dollars every year. For the rest of his retirement, I want to spend a moment on municipal bond interest, because this is the piece of the formula that surprises even financially sophisticated retirees. Municipal bonds are debt instruments issued by state and local governments. The interest they pay is exempt from federal income tax. That exemption is why people buy them. You lend money to a city, the city pays you interest, and you do not pay federal tax on that interest. That is completely true. The interest is not directly taxed, but under the provisional income formula, that tax-exempt interest is explicitly included in the calculation that determines whether your Social Security gets taxed. This was not an accident. Congress specifically included it in the 1983 legislation. The intent was to prevent people from sheltering income in muni bonds specifically to avoid the Social Security taxation threshold. The practical effect for retirees is this. You can hold a portfolio of municipal bonds that generates $8,000 per year in tax-exempt interest. You pay zero federal income tax on that $8,000 directly. But those $8,000 count in your provisional income calculation. And if that $8,000 is what pushes your provisional income from $33,000 to $41,000, from below the upper threshold to above it, you have just turned 85% of your Social Security taxable. At a $24,000 annual benefit, 85% taxable at 22% means $4,488 in additional federal income tax. You tried to avoid taxes with tax-exempt bonds. You ended up paying more taxes on Social Security than you saved on the bond interest. This is not a theoretical edge case. It is a real situation that affects retirees with moderate investment portfolios who invested in muni bonds precisely because they were told they were tax efficient. They are tax efficient for most income. They are a trap in this specific context. The fix is to model your total provisional income before deciding how much of your portfolio to hold in muni bonds. If you are already comfortably above the 85% threshold, muni bonds cost you nothing extra here. You are already fully taxed. But if you are near the boundary, the bond interest can push you into a tier you would otherwise avoid. Now let me give you the specific strategies. These are not complicated. Every single one of them is legal, documented, and used by financially aware retirees every year to reduce their Social Security tax bill. Move 1. Calculate your provisional income before making any large withdrawal. This is the foundational move. 5 minutes of calculation before you take money from your IRA can save thousands of dollars. Take your current year's income, pension, dividends, wages if you have them, and add half your Social Security. Find out exactly where your provisional income stands relative to the thresholds. If you are below $34,000 single or $44,000 married, you are not yet at the 85% tier. Understand exactly how much room you have before a withdrawal pushes you over. If you are above both thresholds, you are already in the full torpedo zone. A large withdrawal still costs you the multiplied rate, but at least you know in advance and can make decisions with open eyes. December 31 is the deadline that matters. Everything you do with your income before that date affects your provisional income for the year. Everything you do on January 1st starts fresh. Move 2. Split large withdrawals across 2 tax years. This is Robert and Carol's solution. If you need $18,000 for a large expense, consider taking $9,000 in December and $9,000 in January. 2 tax years, each one pushing your provisional income up by half as much. The torpedo's impact is cut in half, sometimes eliminated entirely, not because you took less money, but because you spread it differently. The IRS does not care when within the year you take withdrawals. The only date that matters is December 31st. Anything after that is a new year. This split strategy works best when your provisional income in each year lands below the critical thresholds. Run the math both ways before you act. Move 3. Use Roth IRA withdrawals instead of traditional IRA withdrawals where possible. This is the long game version of the torpedo defense. Roth IRA withdrawals do not count toward provisional income. They are not included in your adjusted gross income. They are not included in the formula at all. If you take $18,000 from a Roth IRA to pay for that roof, your provisional income does not change by a single dollar. No Social Security trigger, no multiplied tax rate. The money arrives clean. This is why Roth conversions during your lower income years, particularly the gap years before Social Security and RMDs begin, are so powerful. Every dollar in a Roth is a dollar that will never contribute to provisional income in retirement. Every dollar you convert now is a dollar that never fires the torpedo later. If you have both traditional and Roth accounts, model your provisional income carefully and use Roth money first in years where a traditional withdrawal would push you into, or deeper into the torpedo zone. Move 4. Use qualified charitable distributions to satisfy RMDs without raising provisional income. We have covered QCDs in previous videos in this series, but they connect directly to the torpedo in a way worth stating clearly. If you are 70 and a half or older, you can donate directly from your IRA to a qualifying charity, up to $111,000 in 2,206. And that distribution counts towards your RMD without ever appearing as income on your return. It is never in your adjusted gross income. It never increases your provisional income. It never pulls additional Social Security into the taxable column. If you are in the torpedo zone and you have an RMD due, a QCD satisfies the RMD without triggering the cascade. Compare that to taking the RMD as ordinary income and then writing a check to charity as a deduction. Even with itemizing, you only recover your marginal rate on the deduction. The QCD is the only option that eliminates the provisional income impact entirely. Same donation, dramatically different outcome. You may have seen headlines in 2025 about Trump's One Big Beautiful Bill and Social Security taxes. Let me clear up the confusion, because there is a lot of it online. On July 4th, 2025, President Trump signed the One Big Beautiful Bill Act into law. The bill created a new $6,000 senior deduction for taxpayers age 65 and older, available for tax years 2225 through 228. A married couple where both spouses are 65 or older can claim $12,000 combined. The deduction phases out for singles with income above $75,000 and for married couples above $150,000. This is a real meaningful tax benefit for many retirees, but there is one thing the One Big Beautiful Bill did not change: the provisional income formula. The thresholds: $25,000 and $34,000 for single filers, $32,000 and $44,000 married, are exactly where they were. The 85% maximum taxable rate is exactly what it was. The muni bond trap is exactly what it was. The torpedo math is exactly what it was. The $6,000 senior deduction reduces your taxable income after the provisional income calculation has already been made. It can reduce the actual tax you owe on your Social Security. It will not change whether your Social Security gets pulled into the taxable column in the first place. For retirees with modest incomes who are near but not far above the thresholds, the senior deduction can meaningfully reduce or eliminate their actual tax bill. That is genuinely good news. But the mechanism that determines exposure, provisional income, was untouched. The torpedo zone still exists, the frozen thresholds are still frozen, the cascade effect still fires. The senior deduction is relief applied after the fact. The strategies I gave you in the previous section are prevention applied before. Both matter. Do not confuse one for the other. Before I close, let me give you the exact calculation to run right now. Get a piece of paper and do this in order. Line 1, write down your adjusted gross income. Everything except Social Security, pension, wages, IRA withdrawals you have already taken, dividends, capital gains, rental income. Add it all up. Line 2, write down any tax-exempt interest you received this year. Municipal bond interest goes here, even though it is not taxed directly. Line 3, take your total annual Social Security benefit from your SSA 1099 and divide it in half. Write down that number. Line 4, add lines 1, 2, and 3 together. That is your provisional income. Now compare. Single filer. Below $25,000, zero tax on Social Security. Between $25,000 and $34,000, up to 50% taxable. Above $34,000, up to 85% taxable. Married filing jointly. Below $32,000, zero. Between $32,000 and $44,000, up to 50% taxable. Above $44,000, up to 85% taxable. Which tier are you in? If you are in the 85% tier, and you have not yet made all of your IRA withdrawals for the year, if you were planning a large distribution before December 31st, this calculation tells you exactly what that withdrawal will cost when the torpedo fires. Now you can decide, take it all now, split it across years, shift some to a QCD, or draw from a Roth instead. That 5-minute calculation, made before December 31st rather than after April 15th, is worth real money. Let me bring it all together. The Social Security taxation formula was written in 1983 and 1993. The thresholds that trigger it have never once been adjusted for inflation. What was designed to affect only the wealthiest 10% of recipients now touches more than half. The provisional income formula, adjusted gross income plus tax-exempt interest, plus half of your Social Security, compared to $25,000, $34,000 single, or $32,000, $44,000 married to determine your tier. Tax-exempt municipal bond interest counts toward provisional income even though it is not directly taxed. This is the trap that surprises even financially aware retirees. The Social Security tax torpedo. In the phase-in zone, every additional dollar of income pulls 85 cents more of Social Security into taxable territory. At 12% marginal rate, your effective rate becomes 22.2%. At 22%, it becomes 40.7%. This is mathematically verified and documented by the Financial Planning Association, T. Rowe Price, and the Bogleheads research community. The 4 moves that diffuse it. Calculate your provisional income before any large withdrawal. Split large distributions across 2 tax years where possible. Use Roth IRA withdrawals for expenses that would push you into the torpedo zone. And use qualified charitable distributions for RMDs to satisfy the requirement without raising provisional income. The One Big Beautiful Bill added a $6,000 senior deduction that reduces tax after the fact. It did not change the provisional income thresholds or the torpedo mechanics. The retirees who pay the least tax on their Social Security are not the ones who got lucky with the market. They are the ones who understood this formula well enough to manage around it. Every year. Before December 31st, not after April 15th when the damage is already done. That is the entire point of this channel. If this video helped you, hit the like button right now. 1 second, it helps this reach more retirees who need to understand this formula before they make their next withdrawal. If you are not subscribed yet, hit subscribe and turn on the bell. The next video I am working on covers the RMAA Medicare Premium Surcharge, the silent tax that shows up 2 years after a large income event and adds thousands to your annual healthcare costs. It connects directly to everything we covered today. You will not want to miss it. If you know a retiree who collects Social Security and has never heard the phrase provisional income, and most haven't, send them this video today. The 5-minute calculation I just walked through could change how they plan their withdrawals for years. Drop a comment, run your own provisional income number right now. Tell me what tier you land in. I read every single one, and your situation might become the next video. I'll see you in the next one.